Hey everybody, Marty Mazur here, Tuesday, July 11th, 2023 with your midweek stock market snapshot. It's after hours. Clients will send it to you via email first thing in the morning. This will be the Wednesday morning message. Today we're going to cover the S&P 500. We're just going to look at daily candles or daily charts on the S&P, NASDAQ 100 ETF, the dollar. I want to look at the top holdings, the top four holdings in both the NASDAQ 100 and the S&P, and those would be Microsoft, Apple, NVDA, and Amazon, and just kind of talk at you about how we see things along the way. Okay, so starting first with the S&P 500, let's zero in first on the price chart. And as you can see, that 20-day moving average that we've been tracking here is working quite nicely so far as support, as the market has tried to come down and test that. Now, as I've been pointing out of late, we have just a slight new high, marginal new high, if you will, against what are negative or bearish divergences on the MACD and on the relative strength index, or the RSI, coming off of overbought levels here, with a sell signal on the MACD. So folks, this, again, the breakout, the retest of this, and then coming off of that, although threatening a retest again, looks, the way we look at the technicals, like, at least from this perspective, odds favor another failed test of resistance and then something perhaps notably lower to the downside. Now, tomorrow morning at 5:30 a.m. Pacific time, which is our time zone, we're going to get the June CPI number. And if it comes in hot, if it comes in higher than expected, I think the market's going to sell off, potentially in a not small fashion, at least on that news. If it comes in soft, and I'm leaning towards soft, quite frankly, then we could see a pretty nice rip, albeit temporary in our view, maybe very temporary, in the market, in equities tomorrow morning. If, on the other hand, we actually have a soft number and maybe we get a pop, but then stocks quickly reverse and it gets sold into, that's going to be a box you're going to want to check that suggests that the next leg lower, if indeed there is one, in the bear market could be starting to get going, because what we're going to be looking for is the market actually trading on what we ultimately believe will be the realistic fundamental catalyst for the next leg lower, and that is recognition by market prices, if you will, that the economy is really slowing. And of course, inflation slows with that scenario. So if we had a weak inflation print and markets begin to sell off, and I do not anticipate that tomorrow, quite frankly, on a weak inflation print, but if it were to happen, that would suggest to me that the positioning underneath the market is ready to roll over. Odds favor, we think that we'll get there eventually, but not necessarily in the relatively short term. So indeed, we could get something from the CPI number that pushes this up to yet another new interim high, if you will. We're still not back to the January 2022 all-time highs, but something that would still not look great, because you're not going to burn through these divergences if that were to happen relatively soon. We're embarking upon earnings season this Friday. We're going to get the banks and then a whole slew in the weeks to come. So it'll be interesting to see how things shake out. And of course, anything can happen during earnings season. But I think the driver of general equity prices is going to be the data and how it's interpreted or perceived relative to how the Fed will ultimately react to it. Short term, market's still looking for the Fed to back off. Equity market likes that idea. Our view is if the Fed really begins to back off, that says something not pretty about the overall state of the economy, and therefore overall state of corporate earnings, and therefore stock prices, because they're not discounting recessionary earnings at this point. Doesn't mean all this is going to happen. It just means that our work says that that risk is still under the surface right here. The NASDAQ 100 tracking ETF, I've been painting this picture as being more bearish than the S&P. you come up through here and you can see we're just pushing against what we can call a pretty good uptrend line right there. This looks, like a shorter term rising wedge pattern that we broke below. Have these long extended bearish divergences. Here we came up, tested that level, resisted it against a notable sell signal in the MACD, and real bearish divergences in it and in the RSI. So not a good looking chart technically. Could absolutely explode higher on a favorable CPI print tomorrow. This particular ETF holds stocks that are very long duration, therefore very interest rate sensitive. So this particular index / ETF is going to be quite sensitive to tomorrow's news. I want to bring up the dollar because in our last equity market conditions update, which we do once a month, we pointed out that we've been really getting the dollar right in our technical analysis. Here we became bullish the dollar, right, coming into May, and we had our technical reasons to be that. Dollar rallied quite notably. The market fell quite notably, at least the broad averages. The equal weight average was down over 3.5%. And then we got bearish the dollar coming into June, and even though our overall assessment of conditions was bearish, we said that June could be quite okay because it looked like the setup for the dollar was notably bearish, and we've got this negative correlation going on. And that played out. We had a really good June in stocks as the dollar came down. But then going into July, we had to pull that one back because then we had what looked like real bullish technicals for the dollar. And so sure enough, we broke out of that. But since then, we've actually broken back down. As you can see here, the dollar has really given up this level. A big candle down, boom, 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 5 days in a row with the dollar down. So right now, as we sit here at the 11th of July, clearly our technical analysis turned out to fail. I do find it interesting. If I think about the dollar and how it would react, for example, to a CPI print tomorrow, you could argue that maybe the currency traders are anticipating a soft print. That makes sense to me. I personally am expecting a soft print tomorrow. Base effects suggest largely that it'll be a somewhat mild inflation print compared to what went on a month-over-month basis last June. Once we get to July to the rest of the year, though, those are very low base effects, which means all things equal, higher inflation prints on a year-on-year basis. So that's going to be something to keep an eye on. If the economy does roll over, it's going to continue to bring inflation down while that plays out. But you do have the tailwind for inflation that are going to be weaker base effects. Okay, so the Qs, the NASDAQ 100 index, we're talking Microsoft and Apple are a fourth of the index, and then NVDA and Amazon. For the SP 500, Apple is number one, 7.5%, then Microsoft, then Amazon, then NVIDIA. So we have 18 to 20% or so concentrated in the top four holdings here as well. Okay. So looking at those is where you really have some red flags beginning to pop up. So Apple, biggest company in the world, just hit 3 trillion market cap. Looking at, we have this, this nice uptrend off of the low here coming into the year. It's been quite the move. Shorter term, you go from here to here, you do have a rising wedge that we've broken below, sitting right on top of its 20-day moving average against just really a concerning looking picture in these momentum indicators. Overbought here, not so much a divergence, definitely a divergence here. Sell signal there. Apple breaks down big, and you've got issues for the broader market, just looking at the weighting that Apple has. Microsoft, we haven't updated this chart in a while, but we have this going on, right? Just kind of channeling here. Definitely broke down below there. This one has given up the 20-day moving average with a steep rolling over in the momentum indicators. So Microsoft looks no bueno, to put it mildly. So if you want to play the technicals, actually you would draw a line back here and say, if we get a steep sell-off, where would you think it would stop? Well, I would look for resistance or support, I should say, right here at 320. Below that, I'd actually go all the way down to 280 to the bottom of this gap. I'm not saying that that's going to happen anytime soon. I do expect that, or I should say, I do think it's a very higher than a non-zero probability that we do go back and revisit these kinds of levels before this bear market ultimately comes to an end. And I know textbook definition says it has, but our definition says it is still going. NVDA, you know, the artificial intelligence dream chip maker, right? Remember when they announced just massive, massive gap higher, tested the top of that gap and have been able to hold that. Now threatening to lose this minor uptrend line here. Got a kind of consolidation, symmetrical triangle pattern, threatening the 20-day moving average. Flat here, that would be a bearish divergence. That would be a real bearish divergence. NVIDIA gives up the ghost at 424. Seems like a long ways from here, but you would be looking ultimately first at this market in here, say, 400, then 375. Then there's not a lot stopping it between there and 300. I know that sounds like a lot, but it's really not. I mean, we were just there, toward the end of May, just weeks ago. And I get the news, I get the AI chatter. I'm a believer in terms of the productivity potential there. It's kind of like the internet back in the 90s. It was certainly the internet infrastructure stocks were there. They all got demolished when the tech bubble burst. The companies that utilize the internet, the ones that could really get maximum benefits out of it, those were the stocks that you wanted to own. And I don't suspect it's going to be any different when the dust settles with artificial intelligence either. And then lastly, good old Amazon. Really been holding up better than I thought. We took it out of our core mix here recently, given our macro thesis and even given the stock and the levels and so on. But it's gone up more even since we've let it go. But the technicals still do not look like some place that we want to be, at least not in size, right? So you did break down below this rising wedge pattern. You are now trading just literally pennies above the 20-day moving average. If that breaks, then Amazon is looking next at 120, and then really not much going on. Maybe 110, and then back to $100 a share, which is really just where we were, right? Beginning of May. So again, this risk is there. We could get into the weeds like I did on the last video about derivatives, positioning under the surface, sentiment, and all these kinds of things. And having said all that, favorable inflation prints, soft rhetoric from the Fed, decent earnings over the next few weeks, and we're still just going to continue to kind of meander inside this bear market, waiting for either something to break and that blizzard to hit, or waiting for the forecast to really clear and that soft landing to really be something to be believed and to be invested in. And all that, folks, remains to be seen. So I'll just call it quits right there and say thank you, as always, for watching and listening. Thursday morning, there'll be a written note. Friday morning, end of week video update, and then our economic update later that day or over the weekend. Talk to you later. Bye-bye.